All right, let's talk Cameco. They just dropped their Q4 earnings, and honestly, it's a bit of a head-scratcher. The numbers looked fantastic, but the stock, well, it didn't exactly pop the champagne. So what gives? We're going to break it all down right now.
So here's the big question, the one that probably brought you here. Cameco comes out, they absolutely crush their earnings estimates, and the stock drops about 3%. How does that even happen? It feels like it goes against everything you learned about the market, right? Well, it turns out the devil's in the details, and Wall Street was reading that fine print very, very closely. Okay, let's start with the good stuff, because there was a lot of it. On the profit side, Cameco really delivered. They reported an adjusted 50 cents per share in Canadian dollars. The analysts, they were only expecting 45 cents. So that's a nice $0.05 beat right there. A solid win, no doubt about it.
And it wasn't just the profit. The top line, the revenue, was also a monster. They pulled in $1.2 billion. Now compare that to the $1.09 billion Wall Street was looking for. That's a beat of about $110 million. I mean, that's not just a beat, that's a blowout.
And if you zoom out and look at the whole year, the picture is just as rosy. I mean, look at these numbers. Adjusted net earnings clocking in at $627 million. Adjusted EBITDA is knocking on the door of $2 billion, and they produced 21 million pounds of uranium. By any measure, that's a fantastic year for Cameco. So far, so good, right?
Okay, so this is where the story takes a turn. Guidance and the stock drop. This is really the numbers behind the narrative. With a report card like that, you'd expect the stock to be flying high. But the market is a forward-looking beast, isn't it? It's always about what have you done for me lately, and more importantly, what are you going to do for me next? And Cameco's what's next, well, that's what spooked everybody. And here it is. This is the slide that caused all the trouble. In 2025, they actually produced 21 million pounds of uranium. Great, but their guidance for 2026, it's a range of 19.5 to 21.5 million pounds. Now, the midpoint of that range is 20.5 million. That's less than what they just did. For a stock that's priced for growth, seeing production potentially go down, yeah, that's a major red flag for the market.
But wait, Cameco's management basically said, hold on everyone, this is on purpose. They're calling it intentional discipline. Their argument, and you can see it in this quote, is that by not flooding the market with uranium, they can force prices up. It's like a game of chicken. They believe that if they hold back a little, the big utility companies will get nervous and lock in these super valuable long-term contracts at higher prices. It's a gutsy move for sure. They're trading a little bit of production now for what they hope will be a lot more profit later.
Right. So while everyone was getting hung up on that 2026 production number, management was trying to get them to look way, way down the road. And that brings us to the Westinghouse growth story. This is their long-term play.
And when we say long-term play, we mean it. Look at this number. We're talking about a partnership with the U.S. government that's got at least $80 billion behind it. That's billion with a B. The whole idea is to speed up the rollout of new Westinghouse reactors. This isn't about next quarter's earnings. This is about setting up a revenue stream for the next 20, 30, maybe even 40 years.
And check this out. This isn't just an American thing. Westinghouse has a massive global pipeline. You've got 8 to 10 plus reactors in the U.S., potentially up to 14 in Canada, 6 in Poland, and a bunch more across Europe. Every single one of those dots on the map is a future customer for Cameco. And not just for the uranium fuel, but for the whole shebang, the entire nuclear fuel cycle.
Okay, so it's really important to put this little 3% post-earnings dip into perspective. Let's zoom out. Over the last year, Cameco stock is up over 130%. Compare that to the S&P 500, which is up just over 14%. I mean, come on, this stock has been on an unbelievable run. So this little drop, it's less of a crisis and more of a breather. It's the market digesting that new guidance, not freaking out about the long-term story.
Which brings us to the core of the issue, really. The investor's dilemma. Discipline versus delivery. This is the tug of war happening right now with this stock. Do you bet on management's patient, long-term strategy, or are you a show-me-the-money-now kind of investor?
So let's lay it all out. The bull case is pretty clear, right? It's all about that long-term vision. You're betting on those long-term contracts getting signed at high prices, you're betting on the massive growth from Westinghouse, and you believe this whole disciplined supply thing will give them pricing power. Now the bear case, it's all about the here and now. They're looking at that soft near-term guidance. They're worried about execution. Can Cameco actually deliver? And they know that the revenue from these huge Westinghouse projects can be lumpy and unpredictable. Two very different ways of looking at the same company.
All right, so let's put it all together. What happens now? This is the next call. Here's our thesis on where Cameco is headed. Okay, here's the bottom line. First, our prediction for the next earnings call. The market is going to be obsessed with one thing: production. Can they deliver on what they've promised in their guidance? That's going to be everything. Second, the price action. We think the stock is probably going to trade sideways for a while, just kind of bouncing around in a range. It's waiting for a real catalyst, something big like a new Westinghouse deal to break it out one way or another. And that leads to our rating. For now, we're calling it market perform. The long-term story is absolutely intact, but for the next few months, we think the stock will probably just perform in line with the overall market until we get more clarity.
And as always, just have to say it, this is not financial advice. This breakdown is for informational purposes only. Please always do your own homework before making any investment decisions.